என் வழி தனி வழி. Better don't come in my way.
For those of you who are not able to follow, it's the famous dialogue of Rajinikanth from his movie Padayappa. So what he says is, "Yen vali, tani vali," which means my way is always a separate and my own way, so don't bother. This is going to be the base for today's discussion on one aspect of IND AS. IND AS says that don't disturb me. I have my own tani vali, which is different from IFRS. So let's get started. Hello friends, welcome you all to our IND AS Carve session. There are about 10 carve in IND AS as at March 31, 2019. So what I'll do is, I'll break this carve session into two parts so that it is easy for us to analyze each of the carve. For each carve, we will understand the principle as per IFRS, the new principle as per IND AS, and the reason for this carve. So let's get started. The first carve is pertaining to classification of a loan liability when there is a breach. So let's get to some background of this. Let's suppose that you're running a business and you want a business loan. So you will approach a bank. For obtaining a loan, there is 100 processes which you need to follow. So one of the process, which is a compulsory one where you need to sign, is a loan agreement. This loan agreement has all the terms and conditions based on which the bank is sanctioning you a loan. You will find detailed conditions which are to be adhered by you. So these are nothing but the covenants. So what IFRS says, when you don't adhere to these terms and conditions, the bank has got unconditional right to recall this loan. So IFRS is saying that such loans where the covenants fail on the reporting date, even if the breach is rectified after the balance sheet date, you will have to classify that as current loans, because bank has the ability or bank has the right to recall the loans since you have not adhered to the conditions which are specified. Our boy IND AS is not accepting to this view. So what has IND AS carved out in this case? IND AS says that if the breach is rectified before the approval of the financial statements. So suppose there are covenants like you have to maintain a debt equity ratio of so and so. You have to submit insurance documents and all. Suppose you have to submit the insurance claims, stock statements and all. So if you are not adhering to these procedural covenants given by the banks on the reporting date, that is March 31, 2019, say, and you are submitting it like 1 month later, the bank is not going to come and recall that loan to you from you. So it says if the breaches are rectified after the reporting date, but before the approval of the financial statements. So your board meeting of the company is on May 31st. So if it is rectified before that, you need not classify it as current. It should be classified as non-current liability. So let us understand the reason for this carve out. Under our banking system, usually a loan agreement will have a n number of conditions. Some of these conditions are substantive, like recalling the loan in case interest is not paid. And there are also other procedural conditions like what I said, submission of insurance details, stock statements, etc. So when there are procedural breaches which are happening, usually the banks don't recall these loans if they are completed subsequent to the reporting date. This is due to the customer-banker relationship which is being maintained, and hence this carve-out has been made as it is felt that if the breaches are rectified after the balance sheet date and before the approval of the financial statements, it would be appropriate to inform the users about the true nature of the liabilities being non-current and not current. So it is for the purpose of reporting the actual nature of liabilities, provided bank is not recalling the loans. The second carve-out is on IND AS 10, events after the reporting date. So let me first explain the reason for this carve-out. It is a consequence to the above carve-out which we have discussed. So what IFRS says is, if the rectification of the breach is happening after the reporting date, that event should be considered as a non-adjusting event. So no adjustment to financial statements to be made because of the rectification of this kind of breaches. But our IND AS is very liberal. It says that if the lender, before the approval of the financial statement, has cleared all the breaches and the banker or the lender has also agreed to waive the breach, it can be considered as an adjusting event. So your changes can be made to the financial statements. The third carve-out is on a definition. The definition of the term is previous gap under IND AS 101. So our Indian companies are adhering to the Company Law, Companies Act 2013. So which will notify all the Indian accounting standards, etc. So we have been referring to our previous gap as accounting standards, which is notified by the Ministry of Corporate Affairs. But that cannot be the case with IFRS, right? So IFRS 1 defines previous gap as the basis of accounting that a first time adopter used immediately before adopting IFRS. So the accounting principle thing which is used by the entity before adopting IFRS is referred to as previous gap as per IFRS 1. But IND AS says we are very clear. We have only one gap, that is accounting standards, which is notified and which is prevailing in India. So this is the reason for the carve out. We'll move to the fourth carve out. The fourth carve out is on use of carrying costs of property, plant and equipment on the date of transition to IND AS 101. So we have seen the video on transitional provisions under IND AS. So those of you who are not able to follow, please watch my video on transitional provisions under IND AS. We have discussed about mandatory exemptions and voluntary exemptions. One of the voluntary exemptions available to the companies is that they can choose to carry their items of property, plant and equipment, that is their fixed assets, tangible assets, at the values which is existing in their accounting standard as a starting point. So, if you are going to apply IND AS, it has to be fair value or as per IND AS 16 on property, plant and equipment. So it has to be valued as per IND AS 16 on PPE. So IND AS 101 provides a transitional relief to the entities, saying you need not go back 30 years and do this fair valuation or IND AS 16 valuation. You can take the cost which is there in your accounting standards FS as your starting point for entering into this IND AS ring. So IFRS says that the items of PPE should be recorded at fair value or by using IND AS International Accounting Standard 16 retrospectively, which means if the company is 30 years old, it has to go back 30 years and do this accounting. However, IND AS carved out by having a voluntary exemption on applying this retrospective application of IND AS in this circumstance. So it says that the company can use the carrying values as per the previous gap on the transition date as the deemed cost, that is, it can be used as the starting point. So the reason, as I told you, it is to help the old companies to done away with this retrospective application of IND AS. We'll move to the next carve out. The fifth carve out is on IND AS 28. So IND AS 28 is dealing with investments in associates and joint ventures. So what is IFRS saying? IFRS is saying that if the associates are following a different accounting policy, then you cannot prepare the consolidated financial statements. You will have to re-prepare the associates FS based on uniform accounting policies and then prepare the consolidated financial statements. So as per IFRS, it says that uniform accounting policies should be followed by the associate companies for the preparation of financial statements. If the accounting policies are not uniform, then the associates' financial statements should be changed as per the uniform accounting policies. But IND AS has carved out by adding few words like unless impracticable to do so, where it is impracticable to apply this uniform accounting policy. So what is the purpose of this carve out? We have seen the IND AS applicability. So it is applicable to banking companies also, but it excludes regional rural banks, which is a type of bank for now. So regional rural banks can be associates of nationalized banks, and they are not in a position to use IND AS because it is very advanced for them. Accordingly, to help them out, these words have been added in our IND AS because of this IND AS applicability, which covers all the scheduled commercial banks excluding RRBs.
நல்லதா போச்சு. இப்போ புரிஞ்சிருக்கும்னு நினைக்கிறேன்.
And here we come to the end of today's break time session. I'll take up the second part of IND AS Carve in my coming video. So until then, stay tuned, stay safe and stay updated guys. Thank you one and all. for your patient listening.